We're very excited to have Jordan Tamchin joining us today. I always learn a lot from my conversations with Jordan, and insurance has emerged as one of the key topics of negotiation during our discussions with buyers and sellers on purchasing tax credits. Today, our agenda will be to very quickly do an overview of where we are in the market and quickly cut over to our panel discussion with a real focus on insurance. Please feel free to put any questions you might have in the chat, and we will try to get to all of your questions. The focus is on insurance, but if you have other questions that you'd like to ask related to tax credit transfers, we are also happy to answer those as well. So without further ado, we'll do a quick round of introductions for today's panelists. We can go to the next slide. So I'm Andy Moon, CEO and co-founder of Reunion. I've probably spoken to some of you on this webcast. I work very closely at Reunion with our tax credit buyers, so many CFOs and tax teams at large corporations. Prior to Reunion, I've spent the majority of my career leading clean energy financings in the solar industry. I'll hand it over to Billy.
Hi, good morning, good afternoon, wherever you're calling in from. My name is Billy Lee. I am the president and co-founder of Reunion. Just by way of background, I've been involved in renewable energy finance, tax equity, tax credits for nearly 20 years, and very excited to talk all things transferability and insurance today. Jordan?
You did a great job. So it says that right here. So I'm Jordan Tamchin. I lead the tax insurance practice at CAC Specialty. I'm a M&A attorney by trade. So I started my career at PwC doing tax due diligence and structuring work for private equity funds, and then went over to Simpson Thacher, where I advised the same private equity funds on the tax aspects of M&A transactions. I left private practice to enter the insurance world to help develop and shape the tax insurance market with the focus on tax credit insurance. So I've seen the evolution of the product over the last decade to help facilitate tax equity deals, and then now to facilitate transferability deals. After spending many years on the insurer side, and then came over to the brokerage side to help launch CAC Specialty in the summer of 2019, and launch its transactional liability practice. And as I mentioned, lead its tax insurance practice here. Tax credit insurance is one of the things that we focus on at CAC. Last year, we placed over 60 tax equity or transferability deals. We did over 55 deals through the end of June of this year, and we expect to do another 50 plus by year end. So as you can tell, as a result of the Inflation Reduction Act, it really supercharged the tax insurance industry to help facilitate tax equity and transferability deals.
Fantastic. So we'll go over a few of the market trends. I'll hand it over to Billy to talk about some trends on the deal front.
Yeah, absolutely. I think we wanted to highlight 4 trends that we're seeing over the last 6-9 months. First of all, transfer activity has increased significantly in 2024. I think what we're seeing, probably similar to Jordan, is just very close to wide-scale adoption. Many public and private companies from many different walks of corporate America are actively looking for transfer deals, many of which have the companies have transacted at this point. And there's just been a tremendous amount of activity in the first half of 2024, and we're seeing that continue to accelerate in the second half. That being said, I think once corporate taxpayers are in transaction mode, what we find is beyond having good deal terms in terms of price and payment timing, what we're finding is speed of execution is really a critical factor in winning deals. A lot of these transactions, these credit opportunities come up fast, and a lot of times the successful parties who are able to successful enter into a tax credit transactions are the ones that are able to act quick, not only to provide fast term sheets, go through negotiations on tax credit transfer agreements efficiently and complete diligence, but also have kind of all the necessary approvals in place before they kind of start down this road. This is what we're finding very much a deal economy, and there are a lot of factors that go in, and speed of execution and certainty of execution is very attractive to a lot of tax credit sellers. The scope and coverage of insurance is a key focus of deal negotiation, and obviously it's such a big aspect that we're devoting most of our time on this. So we won't spend a lot of time right now, but there are some areas that we'll talk about with Jordan in particular later. And then finally, I think we're finding that there's more and more interest in ITCs towards the end of the year, and this is primarily due to the lumpiness of ITCs. So when you think about a tax payer who buys ITCs in Q1 or Q2, doing so really requires them to come out of pocket to make those payments, because they have to spread that benefit over their 4 estimated payment dates throughout the year. Now that we're solidly in kind of the second half of the year, more and more buyers are looking at ITCs, particularly the ones that are kind of being placed in service before the fourth quarter. There's a fair amount of skepticism or caution about buying or entering into transactions with credits that have, especially large utility scale projects that have placed in service dates late in Q4, just given the risk that those projects will be delayed through commissioning or construction to Q1, and having those credits becoming 2025 credits instead of 2024. But in general, we're seeing a lot more activity in ITCs than earlier in the year. Next slide.
So I'll go over everybody's favorite topic, which is pricing. The first question we get from most buyers and sellers. I think we've been pleasantly surprised by the speed at which very large corporations have started purchasing tax credits. In some ways, it makes sense. If you're a $500 million or a multi-$100 million taxpayer, the absolute dollar savings in taxes you can achieve through a tax credit transfer just gets very large very quickly. And so for that reason, we've seen quite a lot of competition for some of the large credit opportunities in 2024, and that has driven pricing up. Similarly, as the year has moved on, as Billy alluded to, we're generally seeing some upward pressure on pricing across the board on ITCs, PTCs, as well as the manufacturing credits. So I would say that quite a few buyers that perhaps missed out on opportunities early in the year, or really want to lock something in before the end of the calendar year, are really looking hard to find these projects, and that's really driven a bit of upward pressure on the pricing. That said, we do see somewhat of a price ceiling on ITCs. Some sellers have approached us asking for 95 cents or higher for ITC transactions. But the challenge there is that, with PTCs and production credit, advanced manufacturing production credits trading in the mid-90s, those are less complex transactions. And so I think once you start getting into the mid-90s, most buyers would prefer a simpler transaction at that price point. One other interesting trend that we've seen is buyer fee reimbursement becoming standard. In general, most buyers we work with are very focused on managing above the line expenses, and as a result, they want any intermediary fees, insurance fees paid for by the seller, and to the extent possible, they are negotiating for reimbursements for legal and other diligence costs. Next slide, please. This slide has surprisingly not changed much since we first released it in the very beginning of 2024. Pricing, I think due to the volume of buyers and sellers in the market, we are still finding that credits are trading at fairly narrow bands. Kind of current year production tax credits and Section 45 manufacturing credits tend to trade in the mid-90s per dollar of credit. And this is the price I'm quoting from the buyer's perspective. We do see generally some premium for larger opportunities. within that PTC bucket. For ITCs that we call de-risked, so that have some scale behind them and either have a indemnity from a creditworthy entity or have tax credit insurance, those tend to trade in the low 90s. 91 to 93 cents is what buyers are generally willing to pay. And more complex ITCs can trade at larger discounts, particularly if they are not insured. And one topic we'll talk about is, historically, very small projects have been difficult to get tax credit insurance on because of the relatively, fixed cost you need to sort of procure an insurance policy. We will now move on to the Q&A section, but if you have questions on pricing or on insurance, please feel free to drop them in the chat and we will get to them as soon as we can. So just to set the stage on insurance, we have executed $1.5 billion in transaction volume so far in 2024, and insurance has certainly been a core component in many of our deals. I'd say particularly investment tax credits, which carry basis and recapture risk. We also we've seen insurance on PTC deals as well, where buyers want more confidence in the ability of the seller to fulfill their indemnity obligations. Why don't I start with Billy, actually? We've heard some buyers say, I really want a project with an indemnity from a creditworthy party, so I don't need to deal with insurance. And we see other buyers say, I want insurance no matter what, because I don't want to have to fight a seller for the indemnity. From the buyer perspective, what are you seeing? Is it more common for the buyers to want insured deals or deals where there's a very strong guarantee from the seller?
Yeah, great question. It is interesting. I think in some ways there are some just philosophical differences on how companies approach kind of risk mitigation. And I would say, without having done any scientific analysis here, I would say 70% of the transactions that we are working on or have closed have utilized some form of insurance, but there is a fairly healthy group of taxpayers who either have a inclination to deal with only sellers that have very robust balance sheets, or have some sort of reluctance to kind of rely on insurance. And it's interesting because the folks who there are some folks who only want insurance, right? It doesn't matter if the seller is creditworthy or has a very big balance sheet. As a matter of policy, they want to be able to talk to their management and their board and say, listen, we're doing this deal. We have insurance, full stop. So that is a very interesting feature that, there's folks on both sides of the camp, and there's a lot of folks who kind of will look at, deals both insured and not insured and don't have, a specific policy on that, or aren't very, dogmatic about it, but we'll look at the kind of facts and circumstances of a particular deal.
Awesome. Jordan, you mentioned an impressive amount of deal volume so far this year. Can you describe the most typical types of transactions you're seeing?
Sure. There's basically three types of transactions that you typically see in transferability deal, right? So you have your typical developer sponsor develops a project, no type of structuring to achieve a step up. Your ITC is going to be based on your CapEx, and you allocate that cost, those costs between ITC eligible and non-ITC eligible, to arrive at your ITC amount. And then the developer sells the credits to the buyer, right? So that's pretty the simplest, straightforward case where you don't have any step up. But as you mentioned, buyers still potentially want insurance in those transactions to mitigate some of the other risks that are involved in the transaction that we can get into later. The second type of transaction that you see are historical tax equity transactions, where the Class A investor, the tax equity investor, causes the tax equity partnership to sell all or a portion of the tax credits to a buyer. And this is, a really interesting transaction, particularly from a buyer's perspective and the allocation of risk, particularly when the Class A investor maintains some of those credits or the seller maintains some of those credits. And so that could be attractive to the buyer as well. And a lot of times you have sophisticated tax equity investors who are already done the diligence on the project, and they're comfortable with the underlying, transaction itself, and then a buyer's coming in to buy those credits. And then the third is really like a hybrid type transaction, where you have some type of investor come in, an equity investor, generally a preferred equity investor, come in to help achieve a step up in the transaction that allows the developer to sell the project company to this newly formed partnership to achieve a step up in basis. And it allows the sponsor, obviously, to achieve a higher amount of tax credits in the transaction, and then that new partnership sells the credits to the buyer. So you really see a variety of all three. Earlier on, you probably saw traditional developers who are developing a project just sell credits because they had these new credits that came out under the IRA. There wasn't time to facilitate a potential tax equity transaction or a hybrid structure, like a pref structure, to sell it. And so that's generally what you saw. But now it's becoming more common to see these pref equity structures come in to achieve a step up. So we're seeing a lot more of those. And again, at the end of 23, we saw a lot of large tax equity investors who sold down or syndicated down their investment by selling credits out of tax equity partnerships. So those are generally the three flavors of transactions that you'll see.
And if we zone in on investment tax credits across those three flavors, are you seeing a difference in pricing for insurance on the plain vanilla deal versus a tax equity versus a pref equity structure?
So when it comes to pricing of the insurance, it generally trades in a range, right? So if you're talking about limits or policy size of between $25 million or $20 million, up to, it could be $1 billion, it's generally a range of between 2 to 4% of the limits being purchased. When it gets into the really high numbers of excess of like 300 million, it could be sub 2%. But as you mentioned before, when you go into smaller policy limits, because insurers have minimum premium requirements, that 4% number gets skewed up because you have to satisfy that minimum premium requirement. And that, ranges amongst the different insurers, where some insurers will be able to do it just for $100,000 minimum premium requirement, whereas other insurers would do it for $250,000 minimum premium requirement. And the insurance market is extremely busy right now. There's a lot of trades going on, and so they have their choice on what deals to do. And so unfortunately, you're starting to see that minimum premium requirement tick up because of the opportunity cost of not being able to execute on another transaction.
And Jordan, just honing on that, when you talk about minimum premiums, is that including, typically there's an underwriting fee as well? Are you kind of bucketing that all together, or?
Sorry, yeah, that's just a premium of $100,000. So I would say the all-in cost at the low end of the insurance would probably range somewhere between $175,000 up to $250,000.
Got it.
And then within that 2 to 4% range, how does risk exposure play a role in the pricing? So, for example, a pref equity structure has some structure risk. Will the IRS respect the structure of the transaction? How does that impact do items like that impact sort of where that falls in the 2 to 4% range?
You would think it would, but it really doesn't. If it's insurable to begin with, you're in that trading range. If it's not insurable, then it's just, you're out. It's not going to be insured anyway. But if the insurance market likes the underlying risk transfer, it generally falls within that range. And it's just marginally difference in pricing if it's, more risky, quote unquote. And I think the thing that you're starting to see, and we'll probably hit on it, is when it comes to valuations and step ups. You're starting to see some insurers, most insurers now are really drawing a line in the sand and the amount of step up that they're willing to underwrite to. And if it's on a particularly high end, you're starting to see the primary, the insurer that's taking on the first dollar risk in this insurance program potentially charge a higher rate. But on those larger programs, you're able to blend down that rate to get back into that 2 to 4% range.
Fascinating. And are there other ways that you can bring down the cost, the headline cost of the 2 to 4%? Because as we all know, our tax credit seller friends tend to be very sensitive on pricing. I mean, can you play with retention amounts, or are there other ways to sort of allocate the risk such that the headline cost is lower?
Yeah. So there are a lot of it will come down to relationships that between the broker and the client, the insured, the amount of deals that want deal volume that you're doing. If you're going to be doing more deal volume, potentially you could get that even the underwriting fee down because you develop a relationship with the primary underwriter. You have a form policy, and so you don't have to continuously renegotiate the terms of that policy. They know what you're going to be underwriting to, and so there's ways to bring down that cost. When it comes to the premium side of it, yes, if the insured is willing to take on a retention, i.e. a deductible, then yes, you're able to bring the costs down. But typically in transferability deals, you're not going to a buyer doesn't want any retention whatsoever, right? That's why they're looking to the insurance, because they're trying to mitigate any type of the creditworthiness of the counterparty, and that's why they're getting the insurance. And so once you throw that retention in there, then it throws back into whether or not the seller is able to make it on that, at least that retention portion.
Makes sense. And just to close out the pricing discussion, so obviously investment tax credits have more items to think about, including basis and recapture risk. How does the insurance pricing differ on a Section 45 PTC or a Section 45X manufacturing credit, which obviously doesn't carry the risk?
Yeah, it's significantly less expensive, right? So there's generally less risk involved, right? So if you're doing a PTC deal, you're generally thinking about begun construction or PWA compliance, right? Or you're thinking about any of the adders, domestic content, energy community. Or if you then could throw in the 80/20 repowering for production tax credits, then it starts to get back into that range. 80/20 is a very subjective type test. And so almost like valuation, well, it is a valuation question. So, it's more risk associated with that. Same thing with 45X, less issues, but there are questions about whether or not it's an eligible component for purposes of 45X, and there's not a lot of authority out there. And so lawyers are able to get to, we've seen level of comfort on certain whether or not the equipment qualifies as an eligible component. But even though there's less overall insured tax positions, the market still generally trades around 2 to 4%, but generally on the lower range of it.
Got it. And shifting over to Billy, what have you seen in terms of frequency of insurance on ITC projects versus PTCs?
Yeah, so we have done insurance on ITCs, PTCs, and 45X transactions. And I think in general, there is certainly much more, there's generally much more requirement for insurance on ITCs, primarily because there is that 5-year recapture tail. And there's also that valuation component that was alluded to earlier. I would say that we do have on 45X and PTCs, we have done insurance in cases where the sponsor is just not very creditworthy. So even if it's fairly plain vanilla, really just having a credit enhancement is valuable to the buyer, and also to the extent that certainly if there's a repower, which again, that requires an appraisal, and as Jordan mentioned, that appraisal has some subjectivity no matter who does it. So I think in many cases where there is a 80-20 analysis, a tax credit purchaser would want some sort of insurance. So we see it across the board, and I think we spend just kind of this may be obvious to most people, but we spend time talking about the cost and some of those dynamics. In the vast majority of cases that we see, this seller is procuring or paying for the insurance. So there is a dynamic where if if a buyer requires the best insurance with all the bells and whistles at very high limits of liability, ultimately sellers just look at that as kind of a cost or a deduct on the purchase price. So obviously this is a buyer focused webinar, but we do emphasize to our buyer partners that kind of what is required from insurance is always kind of a negotiated term, and if there's another buyer that doesn't require insurance or requires a much lower kind of set of protection that would ultimately be cheaper, then that goes into the factor of which buyer to go with.
And Jordan, there are some mechanical differences in whether the buyer or the seller procures insurance. Can you maybe give our audience an overview of the difference between seller procured and buyer procured insurance?
Yeah. So this is actually something that is a fascinating discussion. So historically, as part of a tax equity transaction, the sponsor would get the insurance for the benefit of a tax equity investor or for its own benefit to protect its balance sheet, even if a tax equity investor wasn't requiring it. Many times when you see either a hybrid structure where you have a private equity investor coming in or a tax equity partnership, and then let's say the Class A sells down or sells a portion of the credits or all the credits to a potential buyer, a lot of times insurance is already bound by that point, right? And then a buyer is coming in. And so as a general matter, the seller is going to be purchasing the insurance up front. But let's just assume, for the fact pattern, let's just say the buyer has already been identified and seller has not yet got the insurance yet. And so now the decision has to be who's going to get the insurance. Because at the end of the day, seller is going to be the one who's ultimately probably paying for the insurance. They want to make sure that they're actually getting the benefit of the insurance and they're able to abide by the terms and the conditions set forth in the policy to make sure that in the event that there is a claim, because either the IRS audits a covered tax position or there's a section recapture 50 event, they can make a claim under the policy and kind of be in control of speaking with the insurers and collecting the insurance proceeds and then paying it out to the buyer. A lot of buyers, though, want to make sure that the policy has the right bells and whistles in that in the underlying policy to adequately protect them. And so a buyer and their counsel review the terms, and they're generally now included as an additional insured under the policy, so that they too could also bring a claim under the policy and have the same rights as the seller under the policy. If you make it a true buy-side policy, the rules kind of change, and the tax insurers and underwriters don't generally like just to have a buy-side policy, because now the seller is not participating in it, and it's very likely that the seller will be potentially audited for the issues that you're insuring, and then the insurer basically has to rely on the rights of the buyer under the tax credit purchase agreement, and they rather rely on the rights under the tax policy where the seller is the insured, as opposed to trying to have to piggyback off the rights of the buyer under the tax credit purchase agreement. So from a seller's perspective, they don't feel that they're adequately protected if the buyer has their own buy-side policy. The other thing is that under the tax credit purchase agreement, the seller is indemnifying the buyer. And so unless the policy explicitly carves out subrogation rights, in fact, in a buy-side policy, the insurer would be able to step into the shoes of the buyer and then subrogate against its interests. loss paid to the buyer, and basically collect its money back from the seller. And so there is a stark contrast there. But many buyers feel that they're better protected by a buy side policy because there is a potential concern that the seller somehow trips up the policy. But you're also going to have that same argument from the seller's perspective that says, hey, if it's a true buy side policy, buyer could trip up the policy and then still make a claim under the tax credit purchase agreement. And now, the seller is exposed and their balance sheet is exposed.
So I'd like to ask you both, what do you see in practice? Are you seeing buy side policies being procured, or is that more?
So we've worked with 2 large corporates who are insistent on doing a buy side policy, and we were able to get the insurers on board with it. And the counterparty, the seller, was actually creditworthy counterparty. I think it was like A-rated basically. And they were at the end of the day okay with it in both instances, and the insurer had subrogation rights actually against it. The benefit of the buy side policy is that it basically will be able to insure almost the bad acts of the seller, and then the insurer would be able to subrogate against it. But it really is deal dependent, right? The insurer, the underwriter, is going to look to who the different parties are. So it's not going to work in every example, right? So in this particular, those 2 examples that I mentioned where we did procure buy side policies, you had a creditworthy seller. There was subrogation rights. The parties were very sophisticated. And so the insurers were okay with basically having subrogation rights against the seller for certain bad boy, events. But generally that's not always the case, right? A lot of times the developer is not creditworthy. It could be 3 guys that are developing some solar assets that are looking to transfer the ITCs. So it's not always going to work in all those scenarios. So it's really deal dependent, and I wouldn't want to make like anything and say that there's a precedent that insurers are willing to do and be okay with subrogation rights. So to answer your question, most of the policies that we get are what we call sell side policies, and the buyer is then included as an additional insured and generally a loss payee under the policy.
Jordan, quick 2 questions on that. In that example, did the seller ultimately agree to pay for the buy side policy? And number 2, did the insurer actually explicitly need the seller to agree to be subject to subrogation, or is that just kind of stepping to the shoes of the TCPA?
Yeah. So the seller effectively paid for it because the buyer offered less of for the purchase amount for the credits. The seller was aware of the insurance, and you didn't have there was no carve out for subrogation against the seller. And in one of the deals, it explicitly said it in the tax credit purchase agreement that there were subrogation rights against it. In the other, it was quiet. It was silent on it, but effectively, because the buyer has an indemnity against the seller in the TCPA for certain issues, including the covered tax positions that were insured, the insurers would basically be able to step into the shoes of the buyer and subrogate and collect in the event of a loss. And to go back to another point that we were talking about, that was a very inexpensive policy because of that subrogation right against a creditworthy counterparty. So that is another way to effectively reduce the cost of the insurance.
Got it. I mean, I think in our experience, we also, the vast majority of our transactions have sell side policies. I think there's a few practical matters. One is typically most buyers are, a lot of them that we work with are publicly traded, and to go out and buy an insurance policy that is kind of not paid for by the seller creates an above the line expense for a transaction that creates a below the line benefit. And we're seeing this. This is, I think, why the vast majority of buyers want the sellers to pay kind of transaction costs directly, because a lot of these tax directors are basically being compensated by bringing their tax rate ETRs down and savings on taxes. So that's one very practical reason. We do see also more and more, almost commonplace, and love to hear your thoughts. But we do see, separate buyer and seller rep letters. So there's not just one rep letter. There's a buyer rep letter and a seller rep letter. If the seller busts its reps or covenants, then then the buyer's not affected from a coverage standpoint, and vice versa. I think the obvious exclusion to that, the obvious risks that kind of everyone bears, is the kind of recapture one, where a seller causes a recapture, and I think you kind of that would be in that bad boy bucket that you mentioned, including like not filing your taxes or taking some inconsistent positions. And I think that's not, again, you can go through some real surgery to get that covered by buying a policy, buy-side policy, and then having subrogation rights. But ultimately, the carrier is going to be interested in this credit of the seller. Part of what we communicate to the buyers is, that event where there is a recapture that's caused by a seller really is somewhat of mutually assured destruction, because they are creating now a recapture event that is subject to indemnification. So they are creating a liability, number one. Number two, if they're selling the project, presumably the buyer will do due diligence and want to make sure that by acquiring the project LLC, they're not, acquiring some sort of contingent liability. So I think it's fairly remote. It borders on, fraudulent behavior. And, the other instances of recapture really are things like, that are generally covered under property and casualty insurance. So there would be money to rebuild. But curious, Jordan, like, how do you think of kind of recapture and likelihood? And also, like, have you seen it? Like, we have, since almost 20 years of 30% ITC or close to 30% ITC experience, like, how many recaptures have you seen kind of, in your history?
Yeah. So to your first point about how does a buyer get comfortable, right? So with certain of the exclusions in the policy. So the typical exclusions that you have in the policy, as you mentioned, are really post closing or post policy inception events, right? Where you have one is an inconsistent filing position. You take an inconsistent position with the cover tax position. Two is you have that amendments to the underlying transaction documents that materially alter the risk transfer. And sometimes buyer is not involved in some of those transaction documents. It could be the tax equity transaction documents or the partnership transaction documents in a preferred structure. You have the voluntary transfer of the project during the 5-year recapture period, by the seller. And so these are all things that buyer, perceived risks, right? But they are mutually destructive. And so most buyers get comfortable with the fact that that's just not going to happen. And they understand that the insurance market can't underwrite those risks, right? Where the insurance market is trying to underwrite legal positions with respect to the tax credits, whether it's the qualification, the structure, and then you have the recapture. Yes, recapture is something that is, again, it's a perceived risk, and the insurance market got comfortable with it because there's generally a few events that could cause recapture, right? You have the natural disaster, which, as Billy mentioned, is covered by your property and casualty insurance. And so the insurers would want to vet the underlying P&C coverage to make sure that there's adequate insurance proceeds to rebuild or repair the project in the event of a natural disaster. The other one is, is the project encumbered with project level debt? And generally you see forbearance agreements in place, which gets the insurers comfortable that the lender won't foreclose during the 5-year recapture period. That being said, we've insured projects where there is project level debt and no forbearance agreement, but there are a few insurers that are willing to do that, but you have to now underwrite to the the financials of the project and how they expect. What's the underlying PPAs look like? What's the debt service coverage ratio? What are the interest reserves to the project, right? So those are the things that the insurers will be looking to. In the 10 years of doing this, both as an underwriter and broker, I have not seen a recapture event on a policy. And so it's like one of those things that people make a very big deal about, but you haven't seen it in practice. But it's understandable from a buyer to be concerned about it. But it's one of those things, I think, Billy, as you mentioned, is that if a buyer wants to be motivated, sometimes they have to be commercial about the amount of limits one wants to purchase. And so you see limits being purchased of 100% of the ITC amount plus. We see some buyers actually getting almost 200% of the credit to take into account interest, penalties, and gross up. And so like the fact pattern of something like that happening is basically you have a recapture event in year one, no one reports that, and then the IRS finds it out 5 years later, and you've already accrued interest, penalties, and gross up on that recapture event. And so when you talk about like a fraud event, like that's kind of like fraud, right? Like how don't you report the fact that you don't have an operational asset in the last 5 years? And so I think that's one of the things that I think buyers just have to be sensitive about when they're trying to transact on these transfer deals. But there are some buyers, regardless of them understanding the commercial realities of the inconsistent filing positions and the recapture event or amending the transaction documents, how that is kind of mutual destruction. They're insistent on it, on getting coverage for it. And there are ways to structure policies to get it done. It's a lot of brain damage, and not all insurers are willing to do it. And a lot of that, what goes back to is either some type of indemnification from the sponsor, or via side letter or through subrogation rights. And the policies can be structured like that, but there's very few insurers who are willing to do it on a primary basis. Once you find a primary insurer willing to do it, it's easy to get the excess in markets to follow. But in order to even get there, it then goes to like those softbacks that we discussed before. Like, who are the parties? Does the seller have the balance sheet? Are they reputable? Who's advising them, right? Are credits going to be left behind, right? If credits are going to be left behind at the seller level, that's a really important fact to all these things, right? Because now that people are both have skin in the game, and so those soft facts really matter in helping to solve for those problems.
Yeah, that's super insightful. We have a lot of really great questions, so I'd like to sort of maybe do a bit of a lightning session where we try to get through as many of these as possible. So related to recapture, it sounds like you haven't seen any recaptures, and we certainly haven't seen any ourselves either. We did get a question about what's the current proportion of actual claims made against insurance policies to date. Maybe we can use that to talk a bit about basis step up and kind of where there's been historical claims on basis step up and how that's impacting the insurance market's willingness to insure step ups.
Yeah, so we are seeing more and more claims as a result of ensuring the insured tax position of fair market value and allocating that value to energy property. Ever since Alta Wind, Bishop Hill, California Ridge, Desert Sunlight, you started to see an uptick in IRS audit activity in this space. And we have many clients who have been audited, and the IRS is really focused on this issue. And it's across asset class. So in the solar, right? So whether it's utility scale, residential, commercial, we're seeing it in all aspects of it. There are insurers that are currently going through the process of fighting the good fight. Some are at the appeal level, some are past the appeals level, and then are eventually going to have to go to court unless the insurers settle on the issue. We have had insurers actually already settle and pay out losses when it comes to this. And so there's a lot of noise and buzz in the market when it comes to step ups. And so if we were having this conversation, in Q1 and Q2 of 2023, I would have probably said, yes, there's a lot of increased audit activity, but the insurance market is still willing to insure higher markups. In about Q3, Q4 of 2023, all of a sudden there was a freezing effect in the market, and it changed overnight. And it was hard for me to discuss this with my clients because my clients didn't want to hear it because they're like, how's that possible? We just did a transaction with an X% step up, and now you're telling me we can't get over, why? And so the market has changed drastically. So as a general matter, what we're seeing in the market is the insurance market is willing to insure generally up to 20%, 25%. And then when you get 30% markup, you see a significant decline in market participation. Anything above 30%, unless you have a really good story to tell, and it's got to be really persuasive. And I'm not talking like a 40%, but like 35%, 33%. You could get it done, but anything above 30%, what we're starting to see is retentions. And so what that basically means is that the retention set at the ITC amount resulting from a step up above 30%, and that would be your retention. And so developers and sponsors are now taking that into account. So despite having a appraisal that may result in a higher step up, let's just say 40%, for purposes, given where the insurance market is and what insurers are willing to agree to, is that they'll say, hey, you have to cap your purchase price under your MIPA at a 30% step up. So even though your appraisal supports something higher, you're going to be capped unless you do some type of retention. And we've been able to structure through the retentions where, via side letters, again, where you can protect the buyer. And basically, if the sponsor really is firmly believes in their step up amount, that they're willing to indemnify the insurer for any loss paid that otherwise would have been the retention. So the buyer is still fully protected, and the sponsor would indemnify the insurer for what otherwise would have been the retention.
And are those rule of thumb step up sort of caps at the portfolio level or individual project level? So for example, we get inquiries from a lot of community solar developers that might have 25 or 30% step ups across a portfolio of projects, but there might be individual projects that are 40. Is that okay, or is it kind of project by project?
It's funny. When I underwrote, I always viewed it as a portfolio. People always viewed it as a portfolio, and now people are doing it on a project by project basis. So we're starting to see that's how they're saying it. And so when you do have instances of that, a lot of times when you see the proposals, you'll see like project A has a retention of 100, project B has a retention of 5, because they're looking at it on a project by project basis.
And when you talk about the step up level, there's been some rumblings that the IRS is looking at step ups as cost plus. So in other words, it's a factor of the actual hard costs in the project plus a certain percentage step up, rather than, if there's intermediate transactions along the way. What's your view on sort of when you say 30% step up, is that cost plus, or is that sort of kind of what the final developer took as a step up?
I think the market has different views, so I'm not going to try to read the minds of every underwriter. But I know we have a client, utility scale solar client, where they bought the project at NTP where there's a step up, and then they sell the project into a tax equity partnership and then get another step up in there. And I think the IRS is taking a hard look at that.
Super helpful. One other question we get typically or commonly from buyers is, how deep is the market for insurance? Is there a danger that in 2025 or in the future that insurance markets aren't able to cover the volume of projects that are coming down the pike?
So there is, I would say, probably around $1.5 billion of total capacity out there for any one U.S. tax risk, right? And so we go to the insurance market, which consists of insurers like a Berkshire Hathaway or a Liberty Everest. And we also go to a market which consists of MGUs like Euclid or Ethos. And they're usually back, their capital providers are usually Lloyd's of London syndicates. And we go to over 25 markets for any proposal. Right now, there's no concern about, market participation or availability of capacity. The market is extremely busy right now, as I mentioned. There's robust pipelines. Underwriters are, being fully utilized, and they have a strong interest in it. And so it just really goes to the point of it's almost an underwriter's market, though, where they get to kind of pick and choose which deals they want to do, as opposed to kind of an insured's market where, because there's not a lot of deal flow that, insurers are really being competitive right now on terms and everything. But that being said, I think the insurance market is trying to adapt with transferability. It's still relatively new, right? And I think everyone's still trying to figure out the ins and outs of how to best service buyers and protect sellers at the same time in these transactions. But from a capacity perspective, to answer your question, no, there's no concerns whatsoever when it comes to available capacity in the market.
Super helpful. One last question of keen interest from buyers. So obviously with post-IRA projects, it's too early to have any audit activity, I believe.
Yeah.
But buyers nonetheless are curious to know more about, how long does an audit take? And for maybe pre-IRA projects, have you had to submit documentation to the IRS as part of a tax credit audit? And maybe if you could shed any light on sort of what that process looks like, that'd be helpful.
Yeah, so an audit process takes a very long time, years. We're working with one, from 2019 project, right? Placed in service date. Actually, sorry, it's 2017 placed in service date that's still going through the audit process, right? So it's a very long audit cycle. So generally, you're not going to get picked up on audit probably for a year or two after you file your tax returns, potentially 3. And then you start through the IDR process, which is an information document request that the IRS looks at. That can include reviewing of any of the underlying transaction documents, as well as project level documents like PPAs, and even getting to appraisals. And then the IRS will generally bring in specialists, valuation specialists, industry specialists to look at the information. And then there's generally a back and forth with sharing information, asking questions. Eventually, the IRS will issue either a no change letter if they agree with the position that you take. I don't know, that's really good for everyone. Or they'll issue a notice of proposed adjustment. And then you have to go through the appeals process there. Once you go through appeals and you don't reach a potential settlement, you'll be issued a notice of deficiency. And then from the notice of deficiency stage, you have to pick on which court you would want to fight the good fight, unless you could try to settle again. And then you're either going to the court of claims or to tax court to fight the good fight. And depending on what the precedent is in the different jurisdictions, legal counsel is going to make a judgment on where to pursue. If you go to tax court, it's not a pay-to-play jurisdiction, so you don't have to pay the tax to fight the fight. But if you go to district court, federal court of claims, then you're going to have to pay the tax and then seek a refund.
And then just this has come up in a number of our transactions. Insurance is structured so that typically the insurer doesn't pay out until quote unquote a final determination.
Right.
And is there a scenario in which where basically there's a time difference where ultimately the insured has to pay before the insurer will pay out, or are they all structured such that nobody's coming out of pocket?
Yeah, so no one should be coming out of pocket, right? So contest costs would be advanced. And so even outside of the tax credit space, we insure a lot of transactions in M&A, mergers and acquisitions are an ordinary course of business. insurers cover your contest costs, right? So a lot of times when the policy is big enough and you know you're going to fight the good fight anyway, a lot of people look at it like they're prepaying their claim expenses, right? Because it adds up and it's expensive and time consuming. But claim expenses can be paid on a rolling basis. That's generally negotiated in the policy. So generally, like every quarter, you could submit your contest costs or claim expenses to the insurer, and they'll pay it within 30 days. When there's a final adjudication is when there's a non-appealable decision at the court level, up to the Court of Appeals. You don't have to go beyond the Court of Appeals for the relevant jurisdiction. Or if the insurer settles, then the insurer will pay loss to the insured or to the loss payee, depending on how it's specified in the agreement. Again, you can negotiate the terms in the policy as to when payment will be made. The earliest is generally 30 days because it takes time for the insurers to put something on their reserves and then actually pay it. And then, generally the slowest is 60 days. And so generally it's a negotiation point that ends in the middle of 45 days.
Awesome.
Awesome. Well, we're at the top of the hour here, so thank you so much, Jordan, for joining us today. We did have some really great questions. If we didn't get to your questions, please feel free to send us an email, and we will make sure to answer them offline. But until then, thank you everybody for joining, and we look forward to talking more tax credit transfer soon.